Tesla's stock is priced like a technology platform, but its revenue still depends almost entirely on selling cars. That gap is not new, but right now, it has reached a point where it can no longer be ignored. Full year 2025 revenue fell year over year for the first time in the company's history. Net income dropped 47%. Operating income fell 38%. And yet the stock carries a forward price-to-earnings multiple of 167 times. That is not a valuation built on what Tesla is earning today. It is a bet on what Tesla might become. The tension is not simply about weak deliveries. It is about whether the pivot away from being an EV company is credible enough to justify a multiple that tech platforms earning billions in recurring software revenue would find steep. UBS captured this clearly when it upgraded the stock from sell to neutral, saying it believes Tesla trades more on sentiment, narrative, and momentum than on fundamentals. That is either a warning or a structural feature of how this stock works, depending on which side of the trade someone sits on. Strip away the AI narrative and the EV business is sending a specific signal that deserves attention on its own terms. In the first quarter of 2026, Tesla delivered 358,023 vehicles. That missed analyst expectations and marked the second consecutive quarter of softer-than-expected results. Deliveries declined sequentially, even as they rose a modest 2.2% year-over-year. But that year-over-year comparison flatters the result, because first quarter 2025 was itself 13% lower than first quarter 2024. The base was already soft. In the fourth quarter of 2025, deliveries fell 16% year-over-year, and full-year deliveries declined for the second consecutive year. The company is dealing with a genuine demand problem in its core business, driven by a combination of high competition, an aging vehicle lineup, and the withdrawal of federal EV tax incentives in the United States. Brand headwinds tied to Elon Musk's political visibility are weighing on European sales specifically. FSD regulatory approval remains pending in both China and Europe, which limits the software monetization story in two of the largest auto markets in the world. The bear case is not a prediction of collapse. It is a question of timing. Gross margins from automotive sales are expected to come in at 16% for the first quarter, up from 15% a year ago. The balance sheet holds $44 billion in cash. The business is not broken, but it is generating less than its valuation assumes. And the gap between current performance and required performance is historically wide. Here is the part of this story that tends to get underweighted in the bearish framing. Tesla's energy storage business grew deployments at a 168% compound annual growth rate over the past 3 years. In the fourth quarter of 2025, energy revenue grew 25% year over year, and the segment posted record deployments of 14.2 gigawatt-hours. In the first quarter of 2026, Tesla deployed 8.8 gigawatt-hours of storage. The energy business is not a footnote. It is on a trajectory that, if sustained, could eventually rival automotive revenue and scale. The charging network is also quietly becoming a structural asset. With more than 77,000 connectors globally, and Ford, General Motors, and Mercedes-Benz all adopting Tesla's North American charging standard, the network has crossed a threshold where it generates revenue from non-Tesla vehicles. That is a recurring, high-margin revenue stream that requires no new vehicle deliveries to grow. And then there is the chip development detail that most coverage has not fully absorbed. Tesla completed the tape-out of its AI-5 chip for full self-driving, meaning the design is finalized and it is ready for manufacturing. High-volume production is targeted for 2027. Musk has also indicated that AI-6 and Dojo 3 are already in development. This is not vaporware. Tape-out is a hard engineering milestone. The timeline to production is still long, but the internal chip stack is advancing on a concrete schedule. FSD subscriptions reached 1.1 million active users in the fourth quarter of 2025, up 38% year over year. That user base is paying recurring fees, and every mile driven generates training data that competitors cannot replicate from a standing start. The moat is not the car, it is the data. Tesla plans to spend roughly $20 billion on capital expenditures this year. That figure is more than double last year's $8.5 billion and substantially above the prior peak of $11.3 billion in 2024. BNP Paribas estimates cash burn of $7 billion for the year. Barclays has raised the possibility that Capex could step up further beyond the $20 billion level, which it flagged as a potential negative catalyst in the earnings print. This is where the two valuations collide most directly. If the capital is being deployed productively toward robotaxi, Optimus, and the AI chip stack, then the spending is building a platform that justifies the multiple. If the spending outpaces demonstrable progress, the market will eventually reassign Tesla back toward a conventional automaker multiple, and the distance between those two valuations is enormous. Prediction markets currently assign only a 12% probability to Tesla launching its robotaxi service in California by June 30th. Optimus shipping in meaningful volume by year-end carries only a 21% probability in those same markets. Insiders have been net sellers, with director-level disposals across a price range of $352 to $419 in recent months. The convergence point for all of this is April 22nd. The first quarter earnings call is where Tesla must either demonstrate concrete robotaxi and Optimus progress or absorb another round of sentiment damage. TD Cowen, which maintains a buy rating, sees a slightly positive setup and argues Tesla has low risk of guiding down. Wells Fargo, holding its underweight, points to limited visible progress on robotaxi and Optimus as the central concern. Both are reading the same facts and reaching opposite conclusions. Evidence points toward a near-term rebound if the earnings call delivers concrete Cybercab production timelines and robotaxi expansion confirmation on schedule. The energy and charging businesses provide a floor that makes the absolute downside less severe than the multiple suggests. But if the call disappoints on AI progress while confirming elevated Capex, the narrative premium in the stock is limited support from underlying fundamentals, and the correction path back toward conventional auto multiples would be steep. The stock is not simply a bet on cars or a bet on AI. It is a bet on the speed of the transition between the two, and that transition timeline is the one variable that no analyst, prediction market, or earnings model can currently resolve.